on the NewsChannel 5 network. This is Open Line.
Hello, everyone. Welcome to Open Line. There's been a lot of talk lately about the economy. Are we headed into a recession? What should we do differently, if anything? And that's what we're going to talk about tonight. We have an economist with us, and just kind of what is on the horizon, what are some of the signs that we're seeing, and how should we all react to some of those signs. Happy to have with us Dan Smith, economist at MTSU, a professor, and also the director of the Political Economy Research Institute at MTSU. Thank you for being here.
Of course, I'm very excited to be on.
Well, thanks. And so that's the big question. We're seeing all this stuff in the news. Are we headed toward a recession? What do you say?
Well, first I should give my disclaimer. I'm not a certified financial investor.
Right.
Please don't trade on the advice I give. This is purely educational. But more seriously, the fact that I'm not sitting like on an island suggests that I don't have the foresight to be able to predict these things. But I can tell like what the consensus is, what the indicators we're seeing. And there's an array of indicators that economists look at. Everything from something crazy like what Alan Greenspan looked at, men's underwear sales, all the way to RV sales. I saw people were talking about that the other day, to convention industry conferences, how many people attend a conference. It's all over the board. So people can pick and choose. So you really have to be careful about what indicators you're looking at. And sometimes we look at these past relationships and they end up not being true. So we're happy to dig into this.
And what's the indicator that people have been looking at? It's a very complicated thing, and there's some indication that bond prices rose and stock prices fell, and that means every time that's happened there's been a recession within 2 years or something like that. Is that right? Did I just nail it, or what about that?
Generally correct. That an inverted yield curve historically has, typically, if it's lasted long enough and it's been steep enough, that it has in general led to a recession. Now, it's not necessarily a causal relationship, but it is it's a signal that has historically held fairly true. Not always true.
So let's say there's somebody out there and they're saying, should I buy a house right now or should I wait? Should you make decisions like that based on an inverted bell curve or whatever it is you just talked about? Or, I mean, what about that? So somebody's saying, should I buy a house right now or wait?
Well, in close consultation with their financial advisor.
Right.
But I think most...
Which you're not.
Most prudent financial experts would recommend waiting at this point, because in general we're seeing interest rates fall, including negative in some countries, Germany, Denmark, Switzerland. Wrap your head around a negative interest rate right there for a second, where you actually get paid to borrow money.
That is amazing.
And we see these interest rates continuing to trend downward. We could talk about the reasons why that's occurring, but in most economies, the smart money is that they will continue to fall, and we're in this low interest rate environment.
Because we've had a low interest rate environment for a long time. So I'm actually kind of surprised to hear you say that. Wait, and you think interest rates will go down even farther. Because it seems to me like they're so low and they've been so low that how can they go much lower? But you're saying when I hear negative, there's room to go.
That's where the smart money is, but also the smart money during the stagflation years would have said we'll never see interest rates below 10%. So it could be wrong, but in general, it seems like there's more demand for U.S. Treasuries. And that is in part driving, more people want to hold these safe assets, and that's driving really low interest rates.
And all right, so were you actually concerned? I mean, how concerned should people be when they see this inverted curve, when they see this economic news? I worry sometimes we talk ourselves into a recession. Is that possible? And how concerned should people be?
That's actually my precise point of view. Is I think in this case it could be a self-fulfilling prophecy, and that people are so concerned that when they see an inverted yield curve that they start acting like we're hitting a recession. I actually think a lot of the fundamentals in the economy, if you look at unemployment, look at labor force participation, look at housing starts, the immediate fundamentals look really good. There's some long-term things like private debt and public debt and unfunded liabilities and things like that I'm concerned about. But the immediate stuff all looks good, except that inverted yield curve. And then also, I think there's legitimate concern over the trade war And then I also think there's some uncertainty in Hong Kong right now, obviously, and that's a huge financial center, and that could be driving some of the funky things we're seeing right now in the yield curve as well.
So you've hit some of the points I want to hit. I certainly want to hit the trade war at some point, but I'm interested in what's happening in other parts of the world. And you mentioned negative interest rates. I'm fascinated by that in Europe. Are other parts of the world doing way worse than we are? Are we seeing what's happening in Europe, and how does that impact us?
I think the fundamentals around the world are probably slightly worse than in the United States. It's not terrible. I think things are still looking fairly optimistic, but certainly Germany, Denmark, Switzerland, they're scratching their head right now, right? We're dealing with negative interest rates. And central bankers, I think this is what actually is driving a lot of the concern, is central bankers don't really know what to do. The only central bank with a lot of experience with low interest rates is the Bank of Japan. And we studied their model and what they've done, and we can't pull a lot of lessons from that because it's so unique and hasn't been tried elsewhere. So if a recession hits, we have a central bank that we don't have a firefighting plan for that recession. So while I see the risk of a recession is very low, if a recession hits, I think we have a central bank that is ill-equipped to firefight it because they have such a large balance sheet that during a recession they want to buy up more stuff, but they have such a large balance sheet that they're not lean and mean enough to actually address a recession if it does hit.
The president says we're not headed toward a recession, says all the things you said as far as about the economy is strong, the fundamentals are strong, but he's very critical of the Fed. And again, let's do 101 here. Like I don't know a lot. I think I just called it whatever I just called it, a bell curve, and it's a yield curve. But all right, what does the Fed have to do with it? Why is the president upset with the Fed? And I guess what does he want the Fed to do?
So there's two reasons that the Federal Reserve may be driving this inverted yield curve. One is that since their balance sheet is so large, they're holding so many securities that they're driving up the long-term interest rates. And then they're not letting the short-term interest rates drop enough. So that would mean driving up the long-term rates and driving, I got that mixed up. Even I get confused with this,
it can
right?
be confusing. Sure.
So they're holding a lot of securities and driving up the short-term rates, holding them up too high, and then driving down the long-term rates, and that is one theory for what's causing the inverted yield curve.
And what about interest rates? Is that what it is? Do they set the interest rate, and the president would like it to be lower, or what about the interest rate here in the United States and the Fed's role?
Yeah, so they target an interest rate. They don't directly set it. It gets a little complicated because they just switched operating systems, so I don't want to get too technical, but they used to just buy and sell government bonds and then hit a target rate. But now everything is determined by the interest rates they set on excess reserves. So banks hold on to, especially in an uncertain environment, they hold on to excess reserves above what's required by law. And the Federal Reserve implemented a new policy during the recession, the 2007-2008 recession, to pay interest rate on top of that. So they're actually paid to hold on to those reserves at the Fed. And that is their new operating system. So technically they are setting that one rate, but there's a lot of interest rates throughout the economy, and that's just one short overnight lending rate. But most of the other rates tend to follow that. Now, go ahead. I feel like it's unusual to have the president just presidents have always been frustrated, or are often frustrated by the Fed. It's unusual to have them just blast the Fed as being inept and not smart, and almost like blaming the Fed for every problem. What are the potential dangers of that? There's a lot of dangers. I think all central bankers and most economists recognize the need for, if you're going to have a central bank, it needs to be independent, so they can't succumb to political pressure. Now, what we're seeing with President Trump, the badgering on Twitter, the phone calls looking to remove, at least openly looking to remove a sitting chairperson of the Fed, those were all fairly drastic measures. But we have seen, some of my research has gone back historically. We saw Arthur Burns was berated. We have the Nixon tapes to prove it, right? I mean, he was yelling, get the interest rates down. Almost every election, almost every president is guilty of pressuring central bankers to get the interest rates down. It used to be through the Wall Street Journal. What they do is economists have actually measured mentions in the Wall Street Journal of a presidential administration criticizing the Fed, and it has actually statistically led to lower interest rates by the Federal Reserve. So the Federal Reserve has responded to that pressure. Now we're in an environment where it's like real time with Twitter, right? Where it is very concerning for sound money. Entrepreneurs, the job of starting up a business is so hard already. And if you're messing up relative prices and making it unpredictable and creating uncertainty with how the Federal Reserve is going to respond, and using criteria other than economic criteria, so political considerations to set what those interest rates are, you definitely risk hurting the economy.
So you think, based on this yield curve, we could be headed toward a recession. What type of recession are we talking about? I mean, the last recession that we all dealt with was one of the worst ever. And is there a lighter version of that? I mean, do you think, or could we be headed toward, is there a bubble out there that you're worried about that could be bursting and that could send us into the kind of thing that we experienced a few years ago? What do you think?
So two things. I think immediately the biggest thing, as I mentioned, was the trade war. Trade wars can get vicious. People can get stuck in their positions, and it just escalates really quickly. I'm very concerned about that, and a lot of economists are. I think that's unproductive. The other thing is, as I mentioned, there are some long-term fundamentals that I think most economists are concerned about. These include private debt. I think in some places, real estate markets have overheated again, and especially in the Nashville area, right? I mean, if you've put in a bid on a house, it's really hard, right? There's multiple bids and it's gone before the sign's even put out front. So some indication that they might be heating up a little bit, but we don't know if that's a bad sign. It could be just people want to move to Nashville, right? It's a great place to live. The other thing is automobile debt. I see people are taking out 10-year loans for an automobile. That's just insane. Even if it's farm equipment, that is way too long for an asset that depreciates that quickly. Student loan debt, huge problem. And finally, I think government and the federal debt, unfunded liabilities such as Social Security, Medicare, those that could add up to anywhere between $110 to $211 trillion. Which we can't even wrap our heads around that number. It's just mind-boggling. And then state and local governments with public pensions. These historically been underfunded. Not in Tennessee. Tennessee, they're very well funded. But states like California, Illinois, Kentucky, Alabama, New York have historically underfunded their public pension systems. And especially if there's a crash, that's going to reduce, that they have to put in more money into the system then to shore it up. And that's going to eat away their local budgets, and really, they're not going to be able to pay for normal government services you would expect.
Well, now, part of me was not that worried as I began the show, and now I'm more worried. I mean, the picture you painted is pretty dire. Here's what I know. I don't know everything about what you said, but yeah, the federal debt is going up as fast as it's ever gone. I mean, the federal debt is. If you were worried about the federal debt before, you should be more worried about it now.
Absolutely.
And people don't talk about it now, but it's bad. If you care about a debt, it's bad. But the thing that worries me when you talk about it is, I read an article in the Wall Street Journal about how middle-class families now have to borrow, have to go into deep debt just to stay middle class. And part of that is the automobile. The average cost of an automobile now is $37,000. How do you do that? How do you do that? And the way you do it is you borrow. And what you used to borrow was a 5-year loan, and now these loans are, like you said, 10 years. And what people do after 8 years, when their car is not doing as well, is they'll roll their old loan into their new loan and have another 10-year loan. And some of the decisions that are being made are dangerous, and that concerns me. I'm no economist, but I see how that could be problematic.
Absolutely. I think it stems from kind of a psychology. Okay, I'm graduating from college. I want to have the same lifestyle my parents did. But your parents spent an entire lifetime getting to the house that they're at and buying all of the furniture that they had, the cars that they had. It took a long time to get there, and they, most likely for most people out there, common people like myself, your parents probably had meager years, right? So to expect to have everything they had at age 60 when you are just 30 is just insane, and that's driving this debt. And you're absolutely right. Even as a professor in Alabama for 7 years, and one of the poorest states in the nation, and I was at a regional university, and I'd still drive around and see people driving like really expensive trucks, things that I wouldn't buy, and I know I made more than my students. So yeah, I think it's some irresponsible behavior, and I am concerned long term, but short term, I think that's more of a long-term issue that we're going to have to deal with, but short-term, the fundamentals to me still seem pretty solid. I'm fairly optimistic.
And that is good. And we should have seen the last thing coming.
Mm-hmm.
I mean, in retrospect, it makes such sense that the housing market was overheated and all these things we were doing, selling that debt, and all the things that's been well documented. You know, we should have seen that coming.
Mm-hmm.
Could cars throw us into the same kind of trouble, or is that a smaller portion of the economy and we don't need to be as worried?
It's definitely a smaller part of the economy, but everyone, I mean, almost everyone has it, right? So it is a concern for me. In combination with something else like student debt, like that, I think long term that could cause some issues.
So those kind of debts.
Yes.
And that's what a lot of middle class people have right now.
Mm-hmm.
These are real debts that middle class people have.
Mm-hmm.
All right, we are going to take a break. If you're on the line, Marcus, Lucy, others, hold on. And if you want to call in, there's the number. We've kind of set the table for the discussion. What do you think? There's the number, 615-737-PLUS, 615-737-7587. We'll take a break. Be back right after this.